you feeling as we wrap up what was a difficult month for the bulls? And I believe you were pretty cautious heading into it.
And I've been bullish for the last 5-6 years, and I've been more cautious recently. And I think that there's a couple things that were said here I think that are key. First is, if we think that this trade thing is over with a couple of comments, it's not. So, yeah, the market may rally 1%, but I think that we have to, kind of assume that this is going to be a very prolonged issue. And then the second issue is one, Mike, that you brought up, is this is really all about economic growth until you see the PMIs and the ISM and cyclical data improving. They don't have to improve dramatically, but they have to stop decelerating. It's really hard for stocks to do well. And then this belief that lower interest rates are a good thing. If the last month has taught us anything, is rapidly declining interest rates are not a good thing for markets.
But didn't the last 10 years teach us that they are?
No, I don't think so. If you look at on days where interest rates fall, stocks tend to go down, and that's been really consistent.
John, how are you viewing what the month has given you as an investor, as an asset allocator? Obviously, yields, they have two signals, right? One is it says something about economic growth expectations and inflation and Fed policy. On the other hand, that's the hurdle rate for borrowing and investing. So how does that fit into your process?
Matt,
I'm sorry. I thought it was John.
Oh, so in terms of our process, this looks like a regime that's been playing out. It's a trade war regime that you have to be accustomed to. Slower growth, slower inflation, the consumer doing all the heavy lifting as it relates to the economy. And positioning is key. If you look at this regime, really since we have 20 months now of trade war data to scrub, to look at a playbook for a multi-asset, cross-asset portfolio. And if you look at that, it's defensive equities, it's U.S. quality stocks, it's the dollar, tech stocks. These are all things that we're leaning into at John Hancock Investment Management, and we think that does have legs into the end of the cycle.
Yeah, Matt, I'll take the opposite side of some of that argument, is Jonathan, in that we've seen for now a full 10-year cycle weaker economic activity, and the underlying business investment has really been weak, now since 2009, 2010, and you got a little bit of a pickup right out of the gate with some tax incentives from the president, and then they rolled over. But I think that this is a bigger growth issue, and by focusing only on a China trade dispute, I think underplays the longer term trend here.
Matt?
Yeah, I mean, you could break down the current administration into two different periods. There was the tax cut period in 2017, and yes, you saw a global growth acceleration. China was doing stimulus at that time as well. But really, since the beginning of 2018, as we all remember, the washing machines and solar panels, the starting of tariffs there has been a hindrance to growth. Is it all of the picture? No, it is not. But it is something that we're starting in the history books. We're going to look back at this period, and we're going to see that a trade war regime is going to have certain characteristics, certain commonalities. And we think that we're well positioned to navigate these choppy days like we're seeing today. And we think that's a good way to do it. Quality stocks in the U.S. and dollar denominated.
But you seem to think, Jonathan, this trade war regime that Matt just mentioned is going to go on for a long time.
I do. And first of all, I'm entirely on the same page on how I'd play this. So I think that this defensive positioning is warranted, but I think that we need to start with the assumption that growth is going to be slow for demographic reasons for a longer issue. And when we had China not letting us access their market, or they were subsidizing industries, or they were abusing intellectual property, we didn't seem to be uncomfortable with that as market participants, as long as we weren't, overtly arguing. And now we're trying to right, the president's trying to right, the ship. And by the way, it's probably the one thing where there's real bipartisan support for this type of activity, and we just don't like the bickering over it. But there's no way that we're going to get this in a better place without having to get it uncomfortable for a period of time, and we're in that period right now.
Didn't see the president another day, another tweet, more or less focused on the Fed and Chairman Powell, although not named here, but just wanting them to ease. You think we're going to get more easing, right?
I think the market's forcing the Fed to ease, not because we need it for growth, but because the yield curve is just way too inverted at the short end, and there's no way that the Fed is going to allow that to sustain.
Well, when we talk about, Matt, defensive allocations right now, what do you have in mind? Are you talking about within the equity market? I mean, I noticed today that high-grade corporate bond returns for August, 3.3%, best August since 1982, those blue chip bonds. So where are you recommending investors allocate?
We do actually have an overweight to investment-grade corporate bonds, but the best idea we have right now is infrastructure-related equities. And what we're seeing globally is that central banks have done as much as they can. The ECB doing more quantitative easing, really what benefit is that going to bring? Governments are going to have to start stepping to the plate and doing fiscal stimulus. The best way to do that often is infrastructure. We believe that's an under-owned asset class, undercovered. It provides good, steady cash flows with growth potential. We really like that in your equity part of the portfolio, and we think that can provide defense with a kind of a barbell of technology and quality stocks for global equities.
What do you mean, stocks like Caterpillar?
That would be more on the industrial side. Think more utilities, utility companies around the world. So dividends, defensive cash flow, things people need versus what they want. They need to get on their cell phone. They need an antenna to get that data. Those kind of businesses are really what we think are defensive and secular growth themes in the next couple of years.